This has been a big week in North Texas real estate. DFW is dominating migration, mortgage rates just jumped again, and Denton is gearing up for a $10 billion city within a city. And yes, the 50-year mortgage might be coming. Welcome to Jesse's weekly DFW real estate update. I'm Jesse Showalter. Let's get into it. Today, we're going to break down who's actually moving to DFW and how we stack up against Houston, Austin, and San Antonio. We'll look at a big LBJ office to apartment conversion, talk about what DR Horton's slowdown means for buyers, zoom out to the national market, check in on mortgage rates, spotlight a huge new Denton development, and then I'll wrap with a quick tip on how to use the 10-year Treasury to read where mortgage rates might go next. Let's start local. New data from the Texas Migration Report shows that nearly 520,000 people moved to the Dallas-Fort Worth area last year. That's almost 32% of all moves in the entire state of Texas, both in-state and out-of-state. So how does that compare to the other major Texas metros? DFW came in at roughly 519,000 arrivals, while the Houston metro area was around 376,000, and Austin was roughly 186,000. DFW also posted the largest net population gain in the state at around 8,225,000 residents, with Austin and San Antonio each gaining just under 6,000 and Houston adding roughly 2,500. Even more interesting, a lot of those new DFW residents are actually Texas Trading City. About 19% of people who moved into the Dallas area came from Houston, 13% came from Austin, and 8% came from San Antonio. So yes, we're not just attracting people from California and Florida, we're literally pulling Houstonians, Austinites, and San Antonians north to DFW. For homeowners, this kind of inbound migration is a long-term tailwind for demand and values. For buyers, it means competition isn't going anywhere. And for investors and developers, it explains why we keep seeing big, ambitious projects getting announced across North Texas. And that leads right into our next local story, where an older office tower along LBJ is being reborn as housing. The city-backed plan at 5550 LBJ Freeway will turn an existing 10-story office building into a new mixed-income apartment community. A recent filing shows phase 1 of the 5550 LBJ multifamily project is expected to start construction in February 2026, with a total estimated construction cost of around $69 million and completion targeted for February 2028. Some work has already started, including removal of some existing structures, and the proposal includes nearly 400 units with a mix of affordable and market rate apartments. This is part of a broader DFW pattern. Instead of letting older office buildings sit half empty, developers are converting them into housing in locations that already have infrastructure, access to jobs, and visibility along major corridors. For renters, this means more options in locations that used to be 9-to-5 only office zones. For owners and investors, it signals that the highest and best use of certain properties along LBJ and in parts of Dallas's core is shifting from office to residential. Now let's talk about the biggest home builder in the country and what their latest numbers are telling us about the market. Arlington-based DR Horton recently reported that in its latest quarter, home closings slipped about 1% to 23,368, and for the full fiscal year, home sales fell about 5% to 84,863. Average selling prices nudged lower to roughly 364,900, and net income is down, in part because DR Horton is leaning harder into incentives. On their earnings call, the company said about 73% of its buyers in the most recent quarter received some kind of mortgage rate buydown, up from 72% the previous quarter. Builders are also using upgrade credits and price flex to keep deals moving. This is what a cooling but not crashing market looks like. Demand is still there, but buyers are price sensitive and rate sensitive, and builders have to meet them halfway. If you're buying new construction, this environment is actually pretty favorable. You're more likely to get a concession, a rate buydown, or an upgrade package than you were 2 years ago. If you're selling an existing home, you're now competing with builders who can throw in incentives you can't, which means pricing and presentation matter more than ever. So that's the local landscape. Let's zoom out and look at what's going on nationally. Nationwide, home prices are still rising, but the pace has cooled. According to the National Association of Realtors Q3 2025 report, prices increased in 77% of metro areas, with the national median existing single-family price rising about 1.7% year over year to $426,800. Only about 4% of metros saw double-digit gains, which is a big change from the run-up we saw a few years ago. Regionally, the South, where Texas sits, posted modest growth of around 0.5%, while some Western markets actually saw some price declines. So the big picture is prices are still edging higher, but the days of 10 to 20% annual jumps are behind us for now. For DFW, that likely means more of a steady, sustainable increase instead of the crazy roller coaster of a few years ago. On the mortgage application side, buyers are starting to re-engage. The Mortgage Bankers Association's latest weekly survey shows total mortgage applications were up about 0.6% for the week ending in November 7th. But the key number is this: purchase application jumped almost 6% week over week. And that happened even though the average 30-year fixed rate in that survey moved up to about 6.34%. Refinance applications were down about 3%, which makes sense with rates in the mid-sixes. But the purchase side is where you see real buyer intent, and that's moving in the right direction. In plain language, even with rates a bit higher, buyers are stepping back into the ring. And then there's the headline that's getting all the buzz: the idea of a 50-year mortgage. The White House and federal housing regulators are exploring a 50-year fixed mortgage as a potential affordability tool. The logic is straightforward: stretch the term from 30 years to 50 years, and the monthly payment drops. In one example, on a median-priced home, the monthly payment might fall from around $2,288 to around $2,022. So you could save roughly $250 a month. But here's the catch: over the life of the loan, you pay a lot more in interest. An analysis by Associated Press found a typical borrower could pay roughly $389,000 more in interest on a 50-year mortgage than on a 30-year mortgage for the similar loan amount. Equity builds much slower, and in many cases, the debt could easily outlast your working years. There are also legal and policy hurdles. Current qualified mortgage rules under Dodd-Frank don't allow 40 or 50-year terms for standard government-backed loans. So Congress would have to change the law, or lenders would need to treat 50-year loans as non-QM products with potentially higher rates. So yes, a 50-year mortgage could make the monthly payment look a little friendlier on the paper, but in exchange, you're signing up for a much longer, much more expensive relationship with your lender. It's one of those read the fine print twice situations. All of that ties directly into our next topic, where rates are today and what's driving the latest moves. Let's talk mortgage rates. Last week on November 6th, the national average 30-year fixed rate from Mortgage News Daily was around 6.29%. Today, as of November 14th, that same daily index is sitting around 6.34%. That's an increase of around 0.05% or 5 basis points in a week. Mortgage News Daily describes rates as near the top of their recent range. After the late October Fed meeting, rates moved up sharply, and since then, they've been trading in a relatively narrow band. Yesterday's levels were near the bottom of that November range. Today's are closer to the highs. Part of the recent bump is tied to what happened around the government shutdown. During the shutdown, investors moved into safer assets, which pushed the 10-year Treasury yield down and helped rates ease a bit. Once the shutdown ended and the markets started bracing for a wave of delayed economic data, job reports, CPI, Treasury auctions, and fresh Fed commentary, yields climbed again and mortgage rates followed. Right now, we're not in crisis territory with rates, but we are in bouncy territory, and that volatility is driven by investor nerves, not just Fed headlines. Now, with all that macro context in mind, let's highlight one of the biggest local developments announced this week, and again, it's up in Denton. Hillwood's landmark development in Denton is being positioned as a city within a city, roughly a $10 billion master plan community that could add more than 20,000 residents once fully built out. The site covers about 3,200 acres or roughly 6.75 square miles on Denton's southwest side and will include a mix of residential neighborhoods, town centers, shops, parks, and trail networks. A flagship H-E-B grocery store has already been announced as a major anchor on more than 20 acres near I-35W and Robeson Ranch Road, which tells you the scale and seriousness of the project. The vision is dense, mixed-use districts surrounded by preserved natural spaces, including stretches of the Cross Timbers Forest, plus plenty of connectivity for commuters heading into the rest of the Metroplex. For buyers looking in Denton County, this is massive. Landmark will influence everything from school planning to road improvements to future retail development. For existing homeowners nearby, it has the potential to be a long-term value driver as proximity to a major, well-amenitized master plan community can pull demand into surrounding neighborhoods. And for investors, this is exactly the kind of large-scale, multi-phase project that can reshape a submarket over the next 10 to 20 years. And now for this week's real estate tip. I want to give you a simple way to understand where mortgage rates are headed, without waiting for headlines or guessing what the Fed might do next. Here's a trick. Keep an eye on the 10-year Treasury yield. You don't have to be a finance expert. Just look at the basic chart. Mortgage rates usually move right alongside it. Most of the time, the 30-year mortgage rate sits about 1.5 to 2% higher than whatever the 10-year Treasury is doing. Personally, I added the 10-year ticker in my stocks app on my phone. If you're interested, the symbol is TNX. If you see the 10-year dropping over a few days, that's your early sign that mortgage rates may ease soon. And if you see it jump, that usually means rates are about to tick up. It's not perfect, but it's the closest thing we have to a real-time indicator. This helps you make smarter decisions. If you're shopping for a home and the 10-year starts climbing, that may be a good time to lock your rate. And if it's trending downward, you might have a little more breathing room. The goal isn't to time the perfect bottom, it's to understand why rates move and to stay a step ahead instead of reacting after the fact. So remember, don't just watch the Fed, watch the 10-year. It'll tell you a lot more about what your monthly payment could look like. And that's it for Jesse's weekly DFW real estate update for November 17th. If you found this helpful, don't forget to like, subscribe, and share. Are you thinking about buying, selling, or just curious about your home's value? Reach out anytime. I would love to help you navigate the DFW real estate market. That's it for this week, and I will see you next Monday.